It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. One of the topics I discussed last week has gotten a lot of attention. I've had a significant amount of people reach out to me, and I really appreciate when people do that because I know that I'm making a difference. And the topic that I was discussing last week quite a lot was something known as the 4% withdrawal rule. What I was discussing last week that's garnered so much attention is something known as the 4% withdrawal rule. Now, this is a rule that's been around for literally decades. It's very commonly recommended and referred to. It's a rule of thumb that's used to determine how much money you can withdraw from your portfolio and not run out of money in retirement. The more that you withdraw from your accounts, the higher the likelihood that you will run out of money in retirement. Now, I was comparing this to guaranteed lifetime income products that frankly often allow you to withdraw upwards of double the amount of money guaranteed for life. For example, a 65-year-old can withdraw up to 7.5% of their account value annually, immediately, and guaranteed for the rest of their life. A 75-year-old can withdraw up to 8.5% annually, guaranteed for life. What's so important about this is these withdrawal rates are double the typical recommended rates of withdrawal from portfolios that are typically 60-40, 50-50, or 40-60 stocks, bonds mix. The reason why this is so significant, you understand, if you're 65 and you can withdraw 7.5% of your account value guaranteed for life versus 4%, I mean, that's nearly double. If you had $1 million account, to use an example, typical recommendation would be you would draw $40,000 from your account. With a guaranteed lifetime income benefit, you can withdraw $75,000 annually, guaranteed for life. Well, that's a massive difference. That's a huge increase in income. Again, as you get older, the higher that number is, that guaranteed lifetime income amount. So the bottom line is you can receive upwards of double the amount of income guaranteed for life versus what was recommended, typical portfolio withdrawal rates. Why settle for a 4% withdrawal rate when you could give 7.5 or 8.5% withdrawal rate guaranteed for life? If you're looking to increase your income, once you understand this, it makes no logical sense to restrict yourself to that lower number. So not only can you significantly increase your income for retirement, which is what got a lot of people's attention, obviously, but secondly, you can guarantee that income with 100% degree of certainty. According to JP Morgan, if your portfolio is a typical mix of 60% equity, 40% bonds, or the other way around, 40-60, and you withdraw 4% from your account for retirement, your likelihood of success of that account not running out of money in retirement is somewhere between 85 to 95%. Fairly high degree of confidence that your account will not run out of money based on a 4% withdrawal rule and based on a typical stock bond portfolio mix. These are very, very common numbers. But if you increase that initial withdrawal rate to 5%, so you go from 4 to 5%, your likelihood of success of not running out of money with that same portfolio drops to 60 to 70%. That's a significant drop in likelihood that your money's going to last. If you increase your withdrawal rate to 6%, again, this is all according to JP Morgan, your likelihood of success in not running out of money is between 30 and 45%. In other words, less than half. you're more likely than not to run out of money in retirement if you're withdrawing 6% of your portfolio. That is in stark contrast to a guaranteed lifetime income benefit that allows a 65-year-old, for example, to withdraw up to 7.5% annually, guaranteed every year for the rest of their life. That's a 100% degree of certainty because this is a guaranteed lifetime income. The difference is obvious and dramatic. Now, some of the questions that I've been getting is how can this be done? These guaranteed lifetime income benefits operate much like a pension. Sometimes they're even referred to as private pensions. Somebody who retires from, say, the government, railroad, teacher, post office, those types of employees still receive what's known as a defined benefit plan or a pension plan. Let's use a teacher, for example. The state retirement system plan takes their years of service and their age, and they make actuarial calculation to determine how much that retiree will receive each month, guaranteed for the rest of their life. In other words, they cannot outlive that money. That amount of money is then given to an insurance company who then guarantees to make those payments. Let me use an example of my own mom. A few years ago, she retired as a teacher. The state took her years of service, did an actuarial calculation to determine how much she would receive each month, guaranteed for the rest of her life. A pension check, an income she cannot outlive. Entities like states, railroads, some union pensions, things like this, government pensions, are typically not paid by the state. My mom's pension, for example, is not paid by the state of Arizona. They contract with an insurance company. A certain amount of funds is then given to the insurance company, and their job is to pay out my mom, the retiree, her benefits each month, regardless of how long she lives. Again, it's an actuarial calculation. These insurance companies have been handling these pension, public and private pensions, for literally decades. This is much of what they do. This is in their wheelhouse. Most public pensions are funded by insurance companies. And I remember my mom at one point, there were some financial issues with the state of Arizona. She was understandably concerned about her pension. She knew what I did for a living and asked me, should she be concerned? And my mom was old fashioned. This was some years ago. She used to still receive her checks in the mail. Now it's all direct deposit. But I asked her a simple question. I said, Mom, when you get your monthly check, does it come from the state of Arizona or somewhere else? And she goes, yeah, I get it from some insurance company. I said, bingo. The state of Arizona does not even have the money anymore. It's the insurance company that's paying your pension. The state gave them a chunk of money and is now paying you out monthly, guaranteed for the rest of your life. This is how the logistics of how pensions actually work in most cases. You have the ability to set up a private pension, one where you fund yourself. The advantage you have versus a public pension is you can determine how much income you're going to receive, when that income starts, and of course, it's guaranteed for the rest of your life. So the bottom line, what I'm trying to say is, this has gotten a lot of attention, is you can significantly increase your income for retirement, guaranteed, and in many cases, anywhere from 50, 75, over 100% increase in income, certainly over the 4% rule that's typically recommended for the typical portfolio. Now, the last question I get is, well, what if I'm not quite ready to receive income? Either I'm not ready to retire or I don't need income yet. Again, as I stated before, you can choose when you start that income. And we have many of these guaranteed income products that each year you defer the income, the amount you're going to receive will increase by up to 10% annually. You can quickly see if you defer your income for a few years, the amount of guaranteed lifetime you're going to receive when you do turn on that income stream is significant. Again, if it's increasing 9-10% a year, guaranteed, that's called a roll-up rate. the amount you're going to receive for income is guaranteed to increase that by 9-10% a year, you can quickly see your income is going to increase greatly. So I don't normally talk about things back to back, but I've gotten so much feedback in a positive way and questions and people reaching out. I thought it was important to bring this topic back up and explain further. If you're interested in more information on how to create a guaranteed lifetime income you cannot outlive, or to increase the income you're receiving maybe in retirement now or in the future by 50, 75, even 100% or more, contact me at yourpersonalbank.com. Again, why settle for a 4%, 4 or 5% withdrawal rate when you could have 7, 8% or more withdrawal rate on your money guaranteed for the rest of your life? There's just no comparison. There's another reason I've been discussing this guaranteed lifetime income, because that 4% rule of thumb, the inventor of it, has now come up with a new number. I'm going to encourage you to stay tuned to the next segment, and we'll discuss what that is.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I've been discussing a lot recently about this 4% withdrawal rule on accounts to ensure with a high degree of certainty that you will not run out of money in retirement. And ironically, the guy who invented the rule, Bengan, just came out with a new number. I didn't realize he was going to do that, so it was kind of ironic, the timing. It turns out in 1994, the inventor of the 4% rule, Bill Bengan, introduced this rule, and he determined how much article in the Journal of Financial Planning, and he determined that retirees should be able to withdraw 4% of their investments and that they could live 30 years without running out of money. It turns out the original number actually he calculated was 4.15%, just so you know, but it was rounded to 4%, and the industry took that number and ran with it. As he stated, he's been playing with that number ever since, and he has recently determined, based on the increase in equities returns we've seen over the last decade or so, the new number that he feels is a safe withdrawal rate, not run out of money in a typical portfolio, is now 4.7%. Now, the first thing I would say is I would question the methodology a little bit behind this, because he's increasing the withdrawal rate based on some historical stock market returns we've seen in the last decade or so. Much of that was enhanced by the Federal Reserve easy monetary policy, really low interest rates, quantitative easing at record levels that the Federal Reserve has never done in its history. That's a big part of the reason why the stock market had such tremendous returns for most of the past decade. And if he's using the typical portfolio of 60-40 equities to bonds, or 50-50 or 40-60 even, obviously a significant portion of that portfolio is involved with equities, which have seen have had a tremendous run. There's no argument. The big unknown is, are they going to continue to have that type of run, say, going forward over the next decade or two? Given that the past decade or two was record-breaking, it's hard to believe that that's going to duplicate itself. It's certainly possible, but statistically speaking, unlikely. And there's many reasons behind that I don't want to get into at this point. That's a whole nother discussion. But let's give Bill Bengan his due. and say, okay, the withdrawal rate with a high degree of certainty that you won't run out of money is 4.7%. That means if you had $1 million invested, that you could withdraw $47,000. Well, that still pales in comparison to the guaranteed lifetime income benefits that I was sharing in the previous segment and last week, which, depending on your age, a 65-year-old can withdraw up to 7.5% guaranteed for the rest of their life, a 75-year-old up to 8.5% guaranteed for the rest of their life. Both of those numbers are significantly higher than 4.7%. In other words, would you rather withdraw, if you had $1 million invested, would you rather withdraw $47,000 to live on, or $75,000 or $85,000 even? And would you rather have a high degree of certainty it's going to be successful, let's say 85, 95%, or would you rather have it guaranteed and be 100% likelihood of success? You see my point. So even though the 4% rule, if people take his advice, which again, I'm a little bit suspicious of, because he's using numbers that have been historical records in terms of the stock market returns, certainly over the last decade or two. But even given all that, the 4.7 withdrawal rate is still so much lower than what the guaranteed lifetime income benefit rider will give you. He even points out that it'd be fairly reasonable to start with, say, a 5% withdrawal rate or something along that line and be relatively safe. Again, 5% is still a lot less than 7.5 or 8.5%. Again, if a typical retiree is 65 when they retire, again, would you rather have 7.5% or 5%? I mean, it's kind of a no-brainer, if you know what I'm trying to say. If you want more information on this, contact me at yourpersonalbank.com. Be happy to run some numbers for you. It's really quite straightforward, quite simple. It's a straight numbers to numbers comparison. There's not a lot to think about. Frankly, which one offers you the higher number, more money, and which one's guaranteed versus the one that's not. With a higher number, a higher amount of withdrawal, and being guaranteed, that's just hard to beat. I want to shift gears now to another issue that's going on financially recently, and that happens to be with the bond market. We've discussed a lot about bonds on this show now for quite some time. Bonds are back in the news because they've recently hit, the 30-year Treasury, for example, recently hit over 5%. That's sort of a benchmark that's paid attention to. As I stated in last week's show, it's a really big deal because a lot of institutional investors, like banks, insurance companies, pension funds, these are organizations that are looking for cash flow. Certainly they'll invest in the stock market and the bond markets, but when you see 30-year treasuries, for example, and corporate bonds paying higher rates of return, they tend to shift more and more of their investments to the bond markets, because if they can lock in, say, a 5% return on a 30-year treasury, and that meets their pension requirements, or a bank, it meets their interest requirements, and they can lock that in for the next 30 years, well, by all means, why take risk? Why would they risk that money in the stock market? For, yes, a potentially higher return, but also a potentially less or even a loss. And again, institutional investors, I mean, it's just logical. Institutional investors are far more about mitigating risk than they are about maximizing returns. Again, take a pension fund, for example. They have a certain amount of pension requirements or obligations that they have to pay out to retirees or folks that are going to retire. And they know what type of interest rate or return on investments, I should say, they need to earn to meet those obligations. And oftentimes 5% is sort of a benchmark that's often used in the industry. So when they can get a relatively safe, nearly guaranteed type of return at 5% with a treasury, they're going to jump all over that. Well, again, these are companies that deal with billions and billions of dollars. These are market movers. And when you have many of these big market mover institutional investors shifting from the stock to the bond markets, that has a negative impact on the stock market. There's just no two ways about it. Asset prices are going to decline. The longer the bond market stays strong in terms of returns, and again, the 30-year Treasury at 5% is a really good benchmark. The longer it stays at that level or higher, even, the more that's going to put pressure on asset prices in the stock market. Now, certainly the stock market's going to have its ups and downs. It always does. I'm not talking about the day-to-day ups and downs. I'm talking about the overall trend over the next several months or even next year or two or longer even. And the pressure, why is the bond yields, that's what I'm referring to, the interest rate that bonds are paying, why is the 30-year Treasury at or above 5%? Well, it has a lot to do with government debt. That's the primary reason. See, a government bond, or a corporate bond for that matter, is a debt instrument. So if a company wants to raise funds, say you have a major company wants to buy some equipment, expand their business, they want to raise money, they have a couple of choices. They could go to a bank and borrow it, or they could issue bonds, and investors will buy those bonds. Microsoft bonds is an example of very common and well-known bond that'll pay investors a certain interest rate for a certain period of time, much like a CD. Longer-term bonds will pay typically a higher interest rate. You're committing your money for a longer period of time. The government does the same thing. The problem the government bonds have, though, they have two problems going on. They have deficit spending and the existing debt. The deficit spending is where the federal government is spending more than it receives. And based on some of the current latest numbers that we're dealing with, unless Congress makes some changes, our federal government this fiscal year is set to spend about $1.5 trillion more than it receives. That's a problem. That will actually add on to the overall debt, which is currently at about $36 trillion. The second problem the federal government has is the $36 trillion or so of existing debt on the books. Here's a common misconception. The federal government cannot just print money willy-nilly and put it in circulation. They actually, when they print money, they have to sell a bond against it. When you're printing a record amount of money, you have to sell a record amount of bonds. Basic supply and demand tells you when you have a lot of bonds, that means how do you entice these bond buyers to buy them? You got to increase the interest rates, right? You got to sweeten the pot to get them to buy them. That's what's been pushing bond yields, bond interest rates up, because they're trying to sell so much of it. So the federal government sells bonds at auctions, at treasury auctions they call them. And recently there was an auction for 20-year treasuries. And this past most recent 20-year treasury auction was the highest initial interest rate offering in the history of the 20-year treasury. Now for buyers, that's great news. They're going to get a higher interest rate. Again, they offered the yield on 20-year treasuries at above 5%. That is the highest rate for a 20-year treasury in history. Now here's the bad news. There was tepid interest in purchasing the bonds. In other words, there was limited buyers. So even though the federal government was offering the highest interest rate for the 20-year treasury ever in history, there just weren't that many buyers. It was one of the worst bond auctions we've seen in a decade or more. This is bad news for the government. It also means the government's going to have to continue to offer higher and higher interest rates, especially if there's fewer and fewer bond buyers out there. It's basic supply and demand. Fewer buyers, more supply. It's going to push the prices up. They're going to have to push up the interest rates they're going to offer to get these buyers to buy them. The government's problem, though, creates an opportunity for you and I. This is why we're in the golden age of fixed assets. This is why interest rates are higher. And folks, I hate to be the bearer of bad news, but if you're borrowing money, borrowing costs are going to stay higher, likely. They're going to stay higher as a result for longer. So don't expect interest rates to be going down anytime in the foreseeable future. The problem is the high level of federal debt. Now, I'm running up on a hard break. I got a couple other points I need to make about this, why this is so important and so important for you to understand financially, for you to make plans going forward, whether it's investing money or borrowing money. This is important for both sides of the coin. And I'm going to show you how to thrive through all of this. You can certainly contact me at yourpersonalbank.com for more information. There's always winners and losers. So it's not a reason to panic or freak out or be worried if you know what to do. Because there's always, as I stated earlier, winners and losers. It's just the economy and the situation we're in has changed, and you need to adapt and change with it if you're going to thrive. Stay tuned in the next segment. I'm going to make a few more points about this to help you understand further and help you thrive.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So in the last segment, I was discussing a lot of what's going on in the bond market, what happened at the most recent 20-year Treasury auction. If you missed any of this, I'm going to strongly encourage you to go to yourpersonalbank.com or the Your Personal Bank app. You can listen to this or any of the previously recorded shows. They each have their own topic, so you can pick and choose and listen to anything that you may find interesting. I think you'll find it very educational. I'm blessed. I don't have anybody telling me what to say or what not to say. That's very rare in media these days, folks. If you don't, probably aware of that. I'm just telling it the straight skinny, how I see it, using my experience, my knowledge, what I'm dealing with clients on a daily basis from coast to coast. So I'm giving it to you as straight as I know how to. And I think most people who listen appreciate that. So let's get back to the point with the bonds and what's going on and what to expect. So as I stated again, the reason why bond yields, why interest rates are staying strong on the upper end is because bond yields are on the higher end. That's the interest that bonds pay. The reason why bonds are staying strong is the federal government debt. Not only are they spending more each year than they receive, but it's the existing debt on the books that's causing a big problem also, the $36 trillion or so. You see, when the government doesn't pay down its debt, when it prints money, it sells a bond from anywhere from 4 weeks to 30 years and every time frame in between to a bond investor, typically an institutional investor like a bank, insurance company, pension fund, etc. But when those bonds mature, at whatever time frame they are, the government doesn't pay down the debt. They just resell that bond at whatever the new interest rate is. Now, the problem for any bond that's, say, 2 or 3 years old or older, it was sold at an interest rate far below what it is today. And to give you an idea of how significant of a difference this really is, if we take the 30-year Treasury, for example, because it's made big news recently because it topped 5%. That's typically a benchmark where many institutional investors, like these banks and insurance companies and pension funds, tend to shift their investing from the stock market heavily to the bond market. Because again, if a pension fund can meet its pension obligations and earn 5% for the next 30 years, that means they've locked in their ability to pay the pensions for the next 30 years. They're set. Institutional investors are not about, in most cases, maximizing returns. Institutional investors, these are folks dealing with billions and billions of dollars, are typically much more about mitigating risk and getting a reasonable return. That's the key thing to understand about the difference of the typical institutional investor who might be dealing with $100 billion or more, and a typical retail investor, an individual who might be, trying to swing for the fences and shoot for the moon and try to maximize their returns. You can kind of understand the difference. You want to pay attention to what the institutional investors are doing. The average holding of equities in the stock market is around 88% institutional money and about 12% retail money. That's the average. When the 88% tends to move, or a significant chunk of that moves elsewhere, from the stock to the bond market, you can quickly understand why asset values in the equities in the stock market can suffer. You really want to pay attention to that. You don't want to go against that tidal wave. You're going to get swamped. Anyway, to get back to my original point, here's the problem that's going on with the bond market and the problem that the federal government has with their debt, and how then I'm going to share with you how you can take advantage of that. So if we go back to about 2020 or so, 2021, the 30-year Treasury was selling at about 1.5% interest. In other words, if you were a bank, insurance company, or pension fund, and you bought some bonds or a sovereign wealth fund or Japan or whoever, and you bought a 30-year Treasury, you're getting about 1.5%. Recently, that same 30-year Treasury is paying 5%. Well, that's more than triple the interest getting paid. That's great for the person who's purchasing that bond. The purchaser is doing awesome. The purchaser of those bonds wasn't doing so hot in 2020 or so. This is why dividends on insurance policies, returns on annuities, and guaranteed lifetime income benefits have increased so much. In fact, the biggest increases we've seen in over 40 years. Because these companies were buying stuff like 30-year treasuries at 2% or less. And now they're getting 5% or more. They're seeing 200% and 300% increases in their portfolios. And when these insurance companies, for example, are being that much more profitable, they can increase or boost the returns on annuities, on guaranteed income benefits, on dividends insurance companies. This is, again, I'm not just saying this because it sounds great that it's a golden era of fixed assets. Folks, it truly is the golden era of fixed assets. And this isn't going away anytime soon. Here's the reason why. The federal government has, in the fiscal year 2025, about $9 trillion of the $36 trillion of debt to refinance or resell. Most of that money, again, was sold as different varying time frame of bonds at much lower interest rates a year, 2, 3, 5, 10 years ago, maybe even 20 or 30 years ago. Now it's being resold at a much, much higher interest rate. It's a record amount of bonds that are being sold or resold, because they're also spending more than they receive, which means they're having to sell those bonds too. So our federal government's selling all-time records. We're talking all-time records in human history, not just in the history of the United States. We're talking of any country ever in human history type of stuff. Tsunami levels of bonds. Because of this huge supply of bonds, they're having to offer higher and higher interest rates to get these institutional buyers to buy these things. The institutional buyers are not stupid either. They know that. And so some of them are kind of holding out and waiting for the higher interest rates. Some can't because they have automated buying systems. They have to purchase. I know of companies that, average buying $1 billion a week of this kind of stuff. But my point is, they're demanding a higher return on this because there's just so much supply, which makes logical sense. The basic law, economic law of supply and demand. But another factor that's affecting supply and demand is who's buying these bonds. Like I've stated before, banks, insurance companies, pension funds, sovereign wealth funds. In fact, the number one foreign buyer of federal debt is Japan. Now that is a problem. And the reason why that's a problem is Japan's economy is even worse than the United States. Their debt is far worse than the United States. Currently, the U.S. debt amounts to about 125% of GDP, or gross domestic product. Think about that as that's the gross domestic product is what our country earns. That's what everyone in our country earns in a year. And we owe about 125% of that. We owe about 36 trillion as a country. Means we earn about 30 trillion as a company. I'm rounding off. That's how much we all make. Individuals, companies, everything annually. Let's put in the numbers that make sense, logical sense to an individual. Let's assume for a minute that you earned $100,000 a year income. Let's also assume you have $125,000 in debt. The interest on your $125,000 of debt is $18,000 a year. That's 18% of what the government's earning. It goes to interest payments currently. This is why I'm not a doomsdayer, but I agree that we have a significant problem that needs to be addressed and is unsustainable. That's why you're hearing this. If you're making $100,000 a year and 18% of your income is interest on your debt, 18 grand a year, can you pay that? And the answer is yes, you can. Now, it's a little expensive. It's going to be one of your larger annual expenses. Typical household making 100 grand a year can afford to pay 18 grand of that in interest in our current economy. What happens when that interest increases to 30% or $30,000 a year? Now we're starting to run into some trouble. Many of you are aware that you don't want to spend more than about 30% of your income, your gross income, on housing. When you start getting above those numbers, 30%, that's when financial trouble starts to occur because you have other expenses. You got food and clothing and, taxes and gas and everything else, all the other stuff that it costs to live. So in other words, the bigger your interest payments on your debt that you owe, the less money you have left over for other things to live on. It's true for the federal government also. So the U.S. is at 125% roughly. Japan's debt to GDP ratio is 260%. In our example, if Japan was earning $100,000 a year, owe $260,000 in debt. The interest payments on that debt are astronomical, frankly, unsustainable. Why do we care about Japan? As I stated earlier, they're the number one foreign purchaser of U.S. debt, of U.S. bonds. They own about 1.1 trillion of our current 36 trillion of debt. Our number one foreign buyer of debt is in far worse financial shape than we are. In other words, they can't afford to buy it anymore. They're struggling. They're in trouble. I predict sometime in the fairly near future, we're going to see a major economic upheaval occur in Japan. Even their prime minister has recently come out and stated that their economic situation is worse than Greece's was 15 years ago. They went through severe austerity measures, which meant that Greece had to live within its means, which is actually a good idea. Amazing thought. But Japan's drowning in debt. They're the worst country in the world. They're the worst industrialized country in the world, and they've got major problems. But the real issue is them being our number one foreign purchaser of debt, the number one buyer, with a weakening system, economy, and everything else, they're going to be less able to purchase the debt. So just at a time when we have all-time record supply, one of our biggest buyers is having trouble buying. So that means even fewer buyers. What's that going to do for the future yields, interest rates of bonds? They're going to continue to rise until this situation gets resolved. I know I've shared a lot of bad news, but it's not all bad news. It's like this is going to be like watching a slow motion crash if it doesn't get addressed. Now, fortunately, the Trump administration is taking steps to attempt to address this. I'm going to discuss this further in the next segment. I'm going to encourage you to stay tuned. I'm also going to share with you how to thrive through this. Again, there are winners and losers. There are opportunities. You have to adjust. You have to change with the changing economic climate, the changing interest rate and climate, the changing bond yield climate. If you want more information, contact me at yourpersonalbank.com, how to thrive. Stay tuned in the next segment. I'm going to share some more about that also.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So we've been discussing a lot about the bond market, bond yields, interest rates, the reasons why higher for longer on interest rates, both in borrowing rates and bond yields and all that, are likely to continue for the foreseeable future. BlackRock, JP Morgan, Vanguard, all of their analysts have all projected that bond yields and interest rates will stay strong for the next 5 to 10 years. I know when I say that, a lot of people are shocked or surprised. Again, the problem is the primary cause of the problem is the high levels of federal debt. And even if the Trump administration and Congress and all of them get it together and they do everything right from a financial responsibility standpoint, stop spending more than they receive for starters, you don't pay off $36 trillion of debt overnight. The problem wasn't caused overnight. It was caused over a period of decades of various administrations, both parties. This has been a long, simmering problem that's built up over time, and now we're getting close to being at the point where we're going to have to pay the piper if we don't do something about it. If you want to ask my opinion, I believe we got about 5 years, maybe 10. Now, there's reason for hope. I'm not a total doomsdayer. The interest on the debt, as I've stated before, is over $1 trillion currently. It's the third largest item on the budget. You got Social Security, you got Medicare, then you got interest on the debt, and then defense spending. We actually spend more in interest now than defense spending. But the real problem, as bad as the interest on the debt is, which it's on its way, it's still climbing, it's still going up. Higher interest rates for longer are going to cause higher interest to be paid. Continuing excess spending is just going to add fuel to the fire. But as bad as all of that is, there is actually something worse. And that has to do with waste and fraud. Doge, for example, has stated that they have found, or they anticipate finding, about $2 trillion a year in waste and fraud in the federal government. That is about a third of all spending the government does. And it's in every department, everywhere you look, it's rampant. And see, the problem is corruption, which is what it is. It's not partisan, it's institutional. Every dollar that's spent propping up these bloated bureaucracies that are either spending too much money, or others that are outright fraud, are just contributing to the problem. An example of that fairly recently was Jennifer Granholm, our former Department of Energy Secretary. In her last 76 days in office, this was the time frame from Trump won the election to the inauguration, she shoveled out $93 billion in quote-unquote loans to green businesses. Most weren't vetted. Most did not have a business plan. By the way, the $93 billion that she shoveled out of just her office alone, that one department, was 3 times her annual budget. That is more than twice that was spent by the Department of Energy in the last 15 years. This is corruption. This is theft. This is embezzlement. When you're shoveling out hundreds of billions of dollars, Doge states upwards of $2 trillion a year, you are doing nothing but adding fuel to the fire to the debt problem. You're digging yourself in the hole even further and faster. This has to stop. There are people in Congress that are not voting for the Doge cuts. Every one of the Democrats are against this, which at this point, frankly, has become not much of a surprise. The Democrats seem to be in favor of spending money whenever possible. But unfortunately, we have some R's, some rhinos, which frankly are not Republicans. They're not conservative, certainly. They're Republicans in name only, which means they're Democrats. Hopefully, through pressure, through the Trump administration, voters, etc., some of these DOGE cuts can be codified into law. It appears some of that is starting to happen. The Congress is starting to put forth some cuts on some areas that are just absolutely egregious. These are some of the reasons why we have the debt that we have, why we're taxed so much as we are, why we have the inflation we've had, why we have the high interest rates that we have now, and why they're going to likely continue for the next 5 to 10 years, again, according to BlackRock, JP Morgan, Vanguard, and others, until that swamp in Washington, the bureaucrats, the thieves, until they're stopped, until this waste and fraud is stopped, this problem is only going to get worse. It's not going to get better. I do have some hope. Some positive direction will happen. Nearly every Democrat is against reducing spending, reducing waste and fraud. If you're fiscally responsible, why would you support that? And by the way, I happen to know you are fiscally responsible because as an individual or a business owner, you cannot be financially irresponsible too long. Otherwise, you don't have a roof over your head. So regardless of your political beliefs and what you think is important or anything else, the largest fiscal challenge our country has is waste and fraud. Our second biggest problem is the interest on the debt. A lot of that was caused by the waste and fraud. If you can't get on board with that and support somebody who's not going to continue to spend more than they receive and not going to allow continued waste and fraud, you're allowing other things to cause you to support that person. And money isn't the only thing in this world, but it sure affects a lot of things in how we live in this world. So I just encourage you to think about that. And that's why one of the last thoughts I want to leave with you is this. The government, in my opinion, can't and should not run a business. Nearly every government-run program ends up the same way. It's bloated, broken, and abused. Medicaid is a great example. We're hearing from many of the Democrat politicians complaining that over 7 million people may lose coverage because they can't manage the paperwork. I'm sorry, I have little sympathy for that. Apparently, 1.4 million illegals, aliens, are on the rolls because the system can't verify citizenship. Those people are not qualified. They should not be receiving it. It's actually against the law. Work requirements, some people are going to lose it because of work requirements, even though they're able-bodied. Well, work requirements are needed because people can just coast for years without doing anything. That's not a healthcare system. That's tax-funded welfare. The bigger point is this. The government should never be the service provider. Not in healthcare, housing, education, banking, food, retirement planning. It doesn't matter. Government's job is to protect its citizens and to provide an even playing field. It sets the rules, enforces contracts, and supposed to punish fraud, not cause it. It shouldn't be running the operations. It should be the referee, not the player. And every time it gets involved in the game, the result is the same. There's no price controls, no accountability, no urgency. And what you get is an endless cycle of growth, dysfunction, and dependency. There's no law to force people to verify their Amazon account. So why do you need a law to force people to verify Medicaid? It's not the law that's the problem. It's the people. It's the structure. The model doesn't work. Government is not the solution. Government is the problem. That's directly from Ronald Reagan. If you want to thrive in this high bond yield environment that's likely to continue, according to JP Morgan, BlackRock, Vanguard, and others, for the next 5 to 10 years, which means higher borrowing costs, which means higher bond yields, many of these institutional investors will be shifting much of their investment over to the bond market and out of the stock market. Overall, that would be a negative effect on asset prices. This is the best time in 40 years for fixed assets, annuities, dividend-paying insurance policies, guaranteed lifetime income. We haven't seen numbers like this in a generation. The government's lack of fiscal responsibility creates an opportunity for you to increase your income, guaranteed for life. As I stated in the first segment, you could increase your income upwards of double, literally, guaranteed for the rest of your life. Annuities are seeing returns we haven't seen in 40 plus years. If you have an annuity that's a couple of years old, you probably should look at the new products, because not only can they pay you a bonus to offset any surrender penalty, but also many can guarantee your returns will be higher than what you would be earning in your current product. If you're considering an annuity as some kind of fixed asset, you really should contact me at yourpersonalbank.com. I'm independent. I have access to nearly every company out there. I can show you the best. Your personal bank dividends are on the rise. They're insured, guaranteed, tax-free, highly liquid. You can create positive arbitrage. You can put more money in your pocket each and every year, guaranteed. You don't have to worry about this uncertainty, the volatility that's going on. Yes, I'm positive, upbeat about the longer-term future. I like all the investments, reshoring manufacturing, but even Trump himself has stated there's a transition period. So the next year or two is probably going to be rough. It's going to be volatile. It's going to be uncertain. It's going to be change. You have to navigate that, adjust to that, reduce your market risk, reduce your exposure, increase your returns, reduce your taxes, increase your liquidity. Give yourself an opportunity to take advantage of the next opportunity that inevitably will come. Things will get better eventually. But right now, there's just too much uncertainty to know what's going to happen. That's not me saying that. It's about everybody out there. And just look at what's going on. I'm positive about the longer-term future, no question. This is my country. I want to see it thrive. But we are going through an economic change that has been built up for the last several decades. There will be some transition. Contact me if you want to learn how to thrive through this. Contact me at yourpersonalbank.com. Stay tuned next week to more great information on the Your Personal Bank Show. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.